Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today are Jack Larch, editor of CTMfile, and Ben Poole, writer at CTMfile. Welcome, gentlemen. Thank you, Jack and Ben, for taking the time to share your thoughts with us on topics that impact the world of treasury management.
Thanks, Push.
Yeah, good to be here.
Thank you. It's time to get your perspectives on our topics for today, namely human leadership in an era of finance, artificial intelligence, increase in greenwashing in Europe, trade corridors in Asia set to outpace global growth rate, API harmonization for cross-border payments, and finally, CFOs to accelerate mergers and acquisitions activity and prioritize ESG for remainder of 2023. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's get started with our conversation. Our first story for today is about human leadership in an era of finance, artificial intelligence, or finance AI. The rapid progress of AI tools in the finance function in recent times has made it more critical than ever for CFOs and finance leaders to demonstrate three core pillars of human leadership: adaptivity, empathy, and authenticity, according to Gartner Incorporated. Jack, as someone with tremendous experience in treasury and otherwise, how do you think treasury and finance teams can foster a successful human and machine partnership where each relies on the other or gets the best out of each other?
That's actually what this article is all about, isn't it? It's the bringing together the AI with the abilities of humans, and it's how to manage this for me, is the biggest problem in AI. And actually, I started reading this article from the bottom for some reason. I'd got the article open, where it's actually the phrase at the end, which sums it all up. To leverage AI, you need to, the Gartner guy said, you need to be cautious about allowing machines to take action based on their own advice. They've got to instead leverage the strengths of both people and the new machine counterparts, their organization, so they can reach new levels of productivity. And it's that mix. And this is the first piece of work that I've seen that brings this together in a formalized way that I actually feel makes sense. I recommend it highly. And if you don't do anything else, read this article.
I couldn't agree with you more. And Ben, for somebody who wrote this article, please throw light on, what you think can make humans and machines work together for the betterment of the corporate sector and corporate treasury in particular.
Well, you mentioned it in your intro, Push, around how quickly the story around AI is developing and changing. I think things look rather different today than they did even just 6 months ago. So it's certainly an area that treasurers need to pay attention to in terms of what's happening. I was lucky enough to actually speak to Mark McDonald from Gartner, who's quoted in the end of that story the other week. And he mentioned that there's a big assumption that a lot of people have that AI can do everything that humans can do. And he just was very adamant that that's totally wrong. And he was keen on drawing an attention to the grey area between AI's human-like capabilities and being human, sort of noting that this grey area is creating a lot of problems at the moment, and it's something that we need to address really quickly to actually be able to move forward and get the advantages of AI, which is kind of like a new type of co-worker, I suppose. It's a new employee in the organization, but it's very different to the old employees. It's got different strengths and weaknesses. And particularly on the weaknesses side, there's a whole bunch that, we're finding out about as people are trying to apply this in various walks of life. So whatever you do, if you're a treasurer, if you're a journalist, if you're whatever you do, we have to be a bit more educated around this topic, I think. For Treasury specifically, I think, there's a whole new level of automation that AI can unlock. So there's plenty of use cases for corporates, from forecasting to cash optimization, risk management, fraud management. And with the development of generative AI, which we've spoken about before, Push, like those ChatGPT style tools, treasurers can go beyond sort of asking, show me my cash forecast, to asking a question like, show me what's wrong with my cash forecast. So it really sort of takes that analytics to a whole new level.
Another important element of this article was how Gartner defined how the modern Treasury and Finance Department really have got to be made up of citizen data scientists, centers of excellence for this organizational stuff, and then company leadership. It's bringing those three things together, which I found very important. And it's critical to way to manage AI, because if you let AI rampant and do things it shouldn't, you're going to get into all sorts of problems. So it's defining how you do it and the way you do it is going to be so important.
Yeah, the framework they mentioned at the conference, which is in the article that you referenced there, Jack, is really, I think, quite smart thinking about how to approach this topic from a corporate perspective.
If I was senior treasurer, I would ask for a day's worth of McDonald's just talking to me about what this means for me, for my department. I found it excellent.
Great article, Ben. Moving forward, the second topic that merits discussion pertains to trade corridors in Asia set to outpace global growth rate. Research by Standard Chartered reveals trade corridors in Asia, Africa, and the Middle East are set to outpace the global growth rate by close to 4 percentage points, driving export volumes in these regions from US $9 trillion in 2021 to $14.4 trillion by 2030. Global trade over the same period is set to reach US $32.6 trillion from $21 trillion in 2021, according to the Future of Trade 2030 New Growth Corridors report. International trade is projected to move away from the West, shifting southward and outward. And South Asia is expected to be the fastest growing export region, driven by strong trade ties with neighboring regions. Jack, if you were a corporate treasurer in the Western world, how would Asia's rising global trade power impact your decision making?
Well, first, I'd be very wary of reports like this. This is done by Standard Chartered, whose whole home market is the Far East. Also, it's part of something that happens in mid-year. You get mid-year reports to give them to something to talk about. The fact that there are 13 key markets is neither here nor there. I found it interesting, though, that the sustainable trade to enable end-to-end ESG compliant supply chains is becoming more focused. You're getting more occurrence of this type of thinking. I'm not sure what is so new about this. Are we saying supply chain finance works? Well, we knew that already. Tracking ESG commitments. The one thing I did take from this that I found new was that the pressure to go west is gone. It's go east, young man. And we're seeing this in all sorts of different ways. This is just a next example.
Yeah, I agree with that, Jack. And, it's it's not a huge shock that Asia might be a region that could outpace overall global growth when it comes to trade like this. Obviously, China's a huge factor in that, but it's not the only reason. We spoke last week about the Indo-Pacific Economic Framework that the US is sort of manipulating to try and tap into those countries aside from China. So when you think about the region mobilizing as a pact together, and throw the US into that and throw in China's economic strength, then I can quite easily see how they might outpace global growth in the next 5 or 6 years. The interesting thing I thought from the research was around how political tensions in the region may impact trade. So businesses were very concerned that geopolitical conflicts could impact their trade capabilities. I think it was over half of the people polled, 54%, kind of highlighted that. And also sanctions, tariffs and export bans were a concern for 44%. And it's not too long ago that Trump was having his trade war with China. I think we all remember that very well. And we're not too far away from the next US presidential election, however that might end up. So, a further outbreak of tariffs or sanctions could put a dent in some of these speculative figures in the research. But as I said off the top, there's no doubt that Asia is a phenomenal producer on the global stage. So shouldn't really be much of a shock, I don't think.
The next story is about the Bank for International Settlements, or BIS, seeking to promote API harmonization for cross-border payments. BIS's Committee on Payments and Market Infrastructures has invited cross-border payment service providers, financial infrastructures, relevant industry associations, and central banks to nominate API experts to join a newly established panel to work on the harmonization of API protocols for cross-border payments. Ben, from a corporate treasury perspective, how significant is this BIS move to promote API harmonization for cross-border payments, and what would you like this newly established panel to achieve?
Thanks, Push. Well, I mean, it's not a new drive, it's a new initiative from the BIS, but it's something we've heard a lot in the past. The need for standardized APIs in financial services is well known because corporates don't want to be programming every time for a different API for the same thing that they're working on. All of these supposed efficiency gains we're making can be just undone by that lack of standardization there. 5 years ago, I think Swift published a white paper called Towards a Global Platform for the Financial Services API Economy, which they essentially described as their blueprint for common API standards. And it would make sense that a body like Swift would get involved on the standards side. But that was 5 years ago, and now we're seeing this similar call from the BIS. So it seems to be something that is spoken about a lot, but in terms of action, I'm not sure how much we're seeing. It would be quite nice to actually speak to some corporates and see kind of their experiences in dealing with multiple banking partners across the world and what the API setup that they have looks like if they have to use a different API for every bank, which certainly a couple of years ago, I think was the norm.
My immediate reaction to this was, why haven't they done it before? They needed it. As you point out, as Ben points out, it's 5 years since the last initiative. That was the first problem. The second problem is I can't see much space for corporates on the panel. We need that desperately. And the other thing it needs is teeth. In other words, regulatory teeth that allow it to impose these standards on the banks so they actually have to use them. It's not given them 5 years and maybe. The problem is this is all taking too long.
Yeah, it shouldn't be your API as a bank that defines you and is kind of the difference maker in terms of whether corporates use your services. It should be the services that are transacted over those APIs that are the difference maker, So a common standard, it's common sense, isn't it?
But it all takes so long.
Yeah. And I think just reflecting on APIs a little bit, obviously they enable systems to interact seamlessly in real time. So anything that adds friction to this like a lack of standardization, is a huge problem. Treasurers want to be using payment APIs to initiate payments directly from the TMS or ERP, or summoning real-time bank balance information from across their various accounts, reconciliation data, real-time FX rates. Like, there's lots of different areas where APIs can be so helpful for corporates, and treasurers have put in a lot of work sort of changing their internal processes so that they can have these real-time data analysis capabilities. So they need that data to actually be coming in real time and when they need it. So yeah, any non-standardization can potentially threaten that.
Interesting. The fourth topic for our post-podcast discussion today is about the European Supervisory Authorities, or ESAs, reporting a clear increase in greenwashing in Europe. The ESAs have published progress reports on greenwashing in the financial sector. In these reports, the ESAs put forward a common high-level understanding of greenwashing applicable to market participants across their respective remits: financial markets, banking, insurance, and pensions. The ESA Progress Report provides an overview of greenwashing in the banking sector and its impact on banks, investment firms, and payment service providers. The outcome of the quantitative analysis of the greenwashing phenomenon shows a clear increase in the total number of potential cases of greenwashing across all sectors, including EU banks. Jack, can you offer a suggestion or two on what can be done to make sustainability-related claims reliable, comparable, and/or verifiable across the EU to reduce greenwashing?
Oh my goodness, what a question. The first thing is that they outline the fact that this practice, this greenwashing practice, isn't just to do with banks. It actually misleads consumers, investors, and other market participants. And that's where we need to drive it from, because this needs driving. The other problem I've got is that this report's only going to be published in May 2024, let alone do anything about it. We need speed. As one of the websites I read regularly is entitled "We Don't Have the Time." And we really don't have the time. I think the governments have to get involved.
Yeah, it's like you were saying on the previous topic, Jack. You know, we need actual teeth to and real consequences to actually get in and be able to stop this at source. You know, I think you need meaningful penalties to those that break the rules, and also investment in policing sort of green financial instruments. One example of this I read about recently was Australia's having its inaugural sovereign green bond launching next year, and the Australian Securities and Investments Commission has allocated another $4.3 million to police greenwashing. So that's just one example of a national authority doing something like that. Earlier this year, we also had the International Sustainability Standards Board endorse worldwide baseline standards for companies to disclose how climate change affects their business. Those standards are set to take effect from January next year for use in yearly reports thereafter. So lots of sort of individual moves being made, but like Jack says, it really needs someone to really kind of take this by the scruff of the neck and make sure that there are meaningful outcomes for people that break the rules now that they've defined them so clearly.
Yeah, I used to work for a guy called Charles Reed, who was employed by the banks to get the international payment systems together. And he went around the world quite literally again and again, seeing banks and individuals to get the collective support for a global initiative, out of which came SWIFT. Well, I think the same sort of thing is needed here. I must admit, I'm very depressed about it.
Yeah, I mean, we're in 2023, and it's not like it's not like climate change is a particularly new topic. So it's the lack of meaningful action, you know, rather than just statements, you know, creating more hot air, basically.
Right. Our next story, moving on from greenwashing to our next story, similar in some perspectives, different in some, is about CFOs likely to accelerate mergers and acquisitions activity and prioritize ESG for remainder of 2023, according to the recent CFO Q2 2023 Outlook survey conducted by Wakefield and sponsored by Oracle NetSuite. Despite the decline in M&A activity last year, companies are looking to grow through strategic acquisitions, and most are likely to pursue small to mid-sized deals, while CFOs, feeling the pressure of ESG adherence, are likely to incorporate ESG initiatives quickly. Ben, I have two questions for you and Jack. First, do you think pursuing small to mid-sized deals over mega deals is a prudent idea in 2023? And second, is the increasing pressure from investors and the broader community to prioritize ESG adherence a welcome development from a corporate treasury perspective? And I use the word increasing pressure very carefully. Ben?
Yeah, thanks, Push. I'll perhaps take your second question first, if that's okay. So I do think that that kind of investor pressure is really important when it comes to ESG, just kind of linking from the last subject that we spoke about, and that pressure to prioritize ESG at an executive level is something that will come down the pipe to treasurers. So kind of going back to that greenwashing story, there's a lot of onus on treasurers, particularly when it comes to investments, to understand where they're putting the cash and that the shiny ESG badge on a fund actually matches the underlying investment that fund itself is making. So treasurers really need to be able to ask the tough questions and kind of get under the hood of those funds. And like I mentioned, we had the Sustainable Finance Disclosure Regulation in Europe that covers sustainability related information disclosures. That's applied since January, but treasurers shouldn't necessarily just rely on a fund's kind of SFDR badge alone as proof that it's meeting the investor requirements around ESG. So that's something to just be mindful of. Your first question around the size of M&As. Well, I suppose that's a little bit cyclical, and markets come together and come apart at different times. But it makes sense, I think, particularly sort of post-COVID, that there are smaller businesses that maybe haven't been able to escape the tailwind of what was going on during the pandemic. And so there might be some quite tasty morsels available to acquire quite easily for companies that have better momentum behind them. So yeah, that's and also I suppose you can get into the sort of monopolies conversation when you get into those big mega deals that are really under the regulators focus. So yeah, so I think those deals will come up, but it's good to see that there is business getting done anyway as we carry on.
And this study is another example of mid-year navel gazing, with Oracle getting into the game. It gives an opportunity to talk about things around what they do. I agree entirely with Ben about acquisitions. It's much more difficult to do large acquisitions that have any scale. And the smaller ones are easier and there are more opportunities. But the returns by definition are less. The issue for me here is that I'm not sure the CFOs have got anything new to offer here. This survey shows no new thinking. So what is my feeling? The issue for me is, how do you manage the really big geopolitical trends coming down the track, including the looming war with China, Cold War with China, the economic climate is declining, and the climate change is ever increasingly important. This is very marginal, interesting but marginal.
One thing that I did find interesting about this was the overall positivity from these finance leaders, bearing in mind they're based in the US, and obviously this is coming very shortly after the regional banking turmoil sort of really kicked off in the States. So that's a good sign. I think it kind of reflects the fact that things are normalizing in the economy a little bit after last year. So obviously inflation has come down in the US from 9.1% last June to I think 4.9% was the last reading. And while the Fed has taken interest rates to their highest level in 16 years with the most recent hike, the rise of 25 basis points was quite far below some of the jumbo hikes that we've seen from the Fed. So I think there's maybe a sense, it's not necessarily an exciting sense, but there's just maybe a sense that the economic situation in the US that was spiraling last year is maybe just a little bit more under control, and you're sort of getting that relief come out in this survey a little bit.
Agreed.
Great. Finally, what is your choice for the biggest or most important story of the past week, and why? Jack, if I can ask you to answer that first.
It's undoubtedly the issue about, or the topic about, that Ben wrote about, the impact of AI on companies and how they manage it. Recognizing the three aspects of human contribution, I think, is important. I haven't seen that quite brought out so clearly. And the role of the CFO and senior managers in managing the balance between that and the contribution of AI, I think is so important. There's some really good wording of how I would do a mission statement for a department.
Yeah, I absolutely agree with Jack there, Push, around the AI topic being my top story of the week. Just finding out what it can do, what it can't, and what the future Treasury plus AI looks like. I think that's a very exciting place that we're in at the moment.
Scary as well.
Right. I would concur, and I would exhort our audience to go ahead and read that article, the AI article on CTMfile.com. Thank you, Jack and Ben, for your valuable analysis and discerning insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.